Welcome to The Unconventional Path, Entrepreneurship and Innovation Stories and Ideas. Hello, I'm bela.and.mike.
And I'm Mike Wasserman.
Today, we are excited to be joined by Brad Svrluga. He is the co-founder and partner in Primary Venture Partners, a VC fund based in New York City that focuses on seed stage investing. Brad will share some of his insights into the world of venture capital investing. He and his partners have built a very successful venture capital fund that manages over $150 million in capital.
So, Bela, there's some history between you and Brad. Do you want to share a little bit of that with our listeners before we go on to the interview?
Sure, Mike. That's a great idea. So Brad, Russ Howard, and I co-founded High Peaks Venture Partners. That was a seed and early stage venture capital fund that focused on investing in upstate New York. After 7 years of investing, we came to the conclusion that we needed to expand our investing geography. This precipitated the migration of High Peaks to New York City and the eventual rebranding into Primary. I was not interested in relocating to New York City, and it was around this time I left High Peaks and became dean of the School of Management at Union Graduate College.
So, Bela, let's frame this up a little bit. We just covered angel investing, which is kind of what we call the entry-level, quote-unquote, component of private equity. Today, we're going to cover venture capital. What's the difference between angel investing and venture capital? And maybe explain kind of the terms you just threw around, seed stage and early stage venture capital funding.
All right. Good idea. So angel investing is often a loosely organized group of individuals who are investing in companies. Seed and early stage VC are professional investors. This is what they do every day. They do this for a living, and they're professionally managing a pot of money that they have raised from other institutions or individuals. So money in venture capital investment typically comes from pension funds, endowments, and other professional money managers. And venture capital's primary focus is on generating a financial return. Sometimes in angel investing, they may have a different primary focus. It may not be just purely about return. It may be about economic development. It may be about giving back to the community. The terms seed and early stage often refer to the first chunk of money or the first investment that comes into a company. There's no bright line between seed and early stage. They sort of both can mean the same thing. But venture capitalists who call themselves seed and early stage investors, they are often the first, what I would call institutional investment that gets made into a company, as opposed to friends and family and angel investors investing in the company. So it's just sort of a continuum of investment. It's seed and early stage is typically the first chunk of money or the label that the industry has put on that first chunk of institutional money. And then oftentimes the next piece is called growth investing, which is sort of helping to grow the company. And then there's sort of mezzanine investing, which is oftentimes larger chunks of money, maybe just before the IPO or sort of just before the company gets acquired. But those are just some labels. They have some meaning, but again, they're not all that specific.
Yeah, they're not legal terms or anything like that with certain numbers attached to them. They tend to work in kind of ranges and they tend to be loose. But it does. Starts with the angel, moves to seed, early stage, growth stage. Mezzanine seems like it should be in the middle, but it's really the last stage typically before an initial public offering or before a company gets sold. Thanks. Makes a ton of sense to me, Bela, and I hope it makes sense to the listeners. With that, I think we should move on to the interview with Brad.
Hello, and welcome to the podcast. Today's guest is Brad Svrluga, who is co-founder and partner at Primary Ventures, which is a seed and early stage venture capital firm based in New York City. Welcome, Brad.
Thanks, Bela.
So could you tell us a little bit about Primary Ventures?
Sure. So Primary is primarily a seed stage firm, venture capital firm, invest in a variety of flavors of companies, all of which have a sort of IT technology at its base. Seed is the earliest stage of institutional investing. You've met an angel investor already at this point. We're often following the stage of which angels come in. Sometimes we're investing alongside angels, and we really will invest from the very earliest stages where it's just one individual with an idea, and we'll give them a little bit of money to start to realize that vision and flesh it out and hire the initial team. And we'll go as late as a company that might have maybe $1 million of revenue, and maybe 10, 15 people on the team. But by and large, we will be the first institutional investor in these companies. So every venture private equity firm that's going to be successful has to define itself with some degree of focus. And for us, that means a couple of things. Number one, that stage is a focus. Number two, for us, geography is a focus. So when my partner, Ben Sun, and I got together and started the firm and started thinking about developing a strategy for what Primary would become, that was in 2013. And that was a point at which the New York City tech ecosystem had started to show some real signs of coming back after the financial crisis. And we had a belief that there was a number of factors that were lining up that positioned New York City and its tech ecosystem exceptionally well for the future, and not the least of which is the fact that New York is home to so many other industries and has such a density of expertise and customers and employee bases to hire from. And so we thought that it was actually a sort of a historical anomaly that New York hadn't been more of a center of the tech community. But when you think about, you're starting a software company that's going to sell to any of the, financial services or media or advertising or fashion or pharmaceutical or consumer packaged goods or whatever, all of these industries are either headquartered or, it's the second or third biggest market for them in New York. And so we thought there was a big opportunity, and the city, for all the capital in town, had very, very little good dedicated early stage capital and very little seed stage capital in particular. So we said, let's plant a flag and go after that. And in doing so, and by geographically limiting ourselves from the beginning, that enabled us to do some things operationally that proved really impactful for our portfolio companies. So the reality is things are all a little different in a post-COVID world, but certainly, we go back to March 1st of 2020, and if I'm sitting in my office on 24th Street, I could literally get to every single portfolio company that we work with within 20 minutes. Maybe there's somebody that takes me 30 minutes to get to. And so that the density of this community makes it easy to have a different kind of impact if you're not trying to, if you're not needing to get on airplanes and run all over the world, or at least all over the country. And so we've always invested heavily in what we call our portfolio impact team and strategy, which is a collection of led by a collection of seasoned tech company operating executives who now are partners with us and spend their time advising and supporting the work of our portfolio companies. So we're now, we have a couple of open roles right now. I think when those roles are filled, we're going to have a 32 or 33 person team, more than half of which is this portfolio impact team that is diving deep and doing real work in the portfolio. And so at the intersection of those two things, geography and this heavy investment in portfolio impact resources, that's kind of what our differentiators are, and they're very much mutually reinforcing.
Yeah. So it sounds like from that description, you guys are very actively involved with the companies that you invest in. Is that unusual, or Or is that typical, or what's the gamut there?
Um, so it you see all flavors, and I think what's going on actually in the U.S. venture industry right now is people are finally realizing that you have to make a decision one way or another on this. And I think we're seeing a kind of a barbelling of the industry where people are either going heavily into this, like, I'm going to really invest in operational impact, and be a high touch and hyper supportive. Or the other end of the spectrum is we're just writing checks and moving on. And you see that both at the seed stage with very high volume firms, and you also see it even at the later stage, and most notably at this point by a firm called Tiger Global, which was a hedge fund has now turned a huge bulk of their business into late stage or even mid stage venture capital investing. And they do an astonishing volume of deals, and they put out an astonishing amount of capital, and they have very little touch points with their portfolio companies afterwards. They're basically stock pickers. They're hedge fund stock pickers who've moved a little earlier into the private capital markets. And there's nothing wrong with that, and they're doing well, and they're making money and driving returns, and they built a great brand. It's just a different thing. So
Yeah.
And what we're seeing now in the venture industry is there's a bunch of people in the middle who, I can't remember who it was, but I read somebody characterize it in a very intelligent way as the people in the middle are like J.C. Penney, which, the U.S. department store brand that tried to be everything to everybody without any specialness to them. And they're gone now because they were stuck in the middle of these like distinctive boutiques and then the big kind of Walmarts of the world.
Yeah. Yeah. So what's your typical investment size?
So we'll go as small as probably $500,000 and as big as 4 million as a first check. 4 to 5 million as a first check. The sweet spot is around 3 or 3.5.
Yeah. So, that's a fair amount of money. And is this something you guys do solo, or is it typically, are you one of the participants in a round of financing for a company?
It's pretty rare that ours is the only capital. One of the things that has changed quite a bit in the U.S. seed and early stage market in the last half dozen years or so is it used to be that it was a very collaborative, a couple other firms that people may be familiar with, First Round Capital, Lair Ventures in New York. The three of us used to do a fair bit of stuff together and splitting deals up 3 ways or 2 ways or whatever. All of us have grown. All of us have had some level of success. And there's been good reasons for us to grow. And as we've grown, it's become harder to be collaborative because if you take a $4 million round and you divvy it up 3 ways, so we're currently investing out of a $155 million fund. If I write a $1.3 million check out of a $5 million fund, imagine that I 20x that, which would be a great outcome on a cash on cash basis. That's $26 million. And the venture math, and we can talk about this if you want, it's an important thing to understand, but the venture math says if a great outcome only returns $26 million on a $155 million fund, that's just not good enough. So we all need to write bigger checks so we can move the needle on our funds.
Yes. As the fund grows larger, the exits need to get larger in absolute dollars. Yeah. Yeah. So there's sort of 2 elements that we think about sometimes. One is the entrepreneur or the founder of the business, and the other one is the industry or sector they're in and sort of the value proposition they have. Can you talk about what you look for in both of those?
Yeah. The first thing I'll say is that we are much, much, much more focused on the founder than the other. And that is, I've been doing this for 20 years. That's a lesson that I've relearned in some new way every single one of those 20 years. And it's a thing that I kind of consistently drive communicating to our younger investment team members, because it's very, very tempting in this business to, read a business plan or listen to a pitch and get really excited about the market opportunity or the, really clever way that the team is approaching this or the product they've designed. But, we're investing in probably the median size company that we invest in from an employee standpoint is 3. So at the time of our first investment. So when you think about a company that has 3 people in it and probably hasn't launched a product yet, everybody involved literally doesn't know what we don't know yet. And so things are gonna change. And so to be either overly enamored of the market or the product or whatever early on before you've seen that, the dog's eating the dog food or the dog's hating the dog food.
Yeah.
Until you've seen that happen, you don't know. What you do know is who are you dealing with? And do I believe these people are going to be exceptional at constantly reevaluating the situation that they're in, being prepared and being nimble and flexible about pivoting, be that a 5-degree pivot or a 90-degree pivot or a 180-degree reversal. And so you can't compromise there. And so one of the ways I frame this for people is founders. So the thing that I've learned to become most focused on is the sort of evangelistic power of the founder. It's salesmanship at some level, and it's not because a lot of people hear that and react negatively because they think like, oh, it's just like, do you want to be backing these kind of used car salesman types? And it's not about salesmanship for salesmanship's sake. It's about what I call the 3 unnatural sales that every founder has to make. Founders repeatedly have to sell 3 different constituencies on a sale that they should never sign up for. So number 1 is employees. I've got a startup. Do you want to come join my startup? And I'll give you a little sliver of equity in it. And I'm definitely going to force you to take a pay cut from whatever gainful employment you have. And when you tell your mom and dad that this is what you're doing now, they're going to get nervous. And they're going to be like, why did you leave your wonderful job at IBM or whatever else? And like, you probably shouldn't take the job because it's probably going to fail. So that's number 1. Number 2 is capital. We lose all of our money a third of the time. And like, we've now been doing this. So like our track record suggests that we're actually quite good at what we do and quite good at what we do and driving like best in class returns in the industry includes losing all of our money a third of the time. So when you're talking to people who are probably going to lose their money, we should probably not invest every time. And when I invest in you, it's not the last time. You're going to have to go make that sale again and again and again to people who are inundated with opportunities.
Yeah.
And then the last is certainly, if it's a B2B sale, is selling customers. And when you don't have any customers, getting your first customer to say, I'm going to shift a critical business process from however I do it right now, which is probably okay, or at least is not going to get me fired if I continue to do it the same way, to taking a risk and buying your product and committing my business to operating in a different way. That's the kind of thing where if it doesn't go well, I lose my job.
Yeah.
And these are, I tell founders all the time, you're not selling software to companies, you're selling software to people with mortgages, with kids who you're saving for college, with all sorts of other psychology that goes into those decisions. And you got to make those decisions easy. So like that salesmanship is so, so important.
Yeah. As you were saying that, Brad, it got me to thinking that I think maybe it's a little broader than being a salesperson, right? It's really about leadership, and
it's leadership,
and getting people. If you're a really good leader, you can get people to act, whether it's to act to join your firm or whether it's an act to purchase something you're selling, right? So it's really a much broader thing than salesmanship.
It's evangelism. Which is like getting people to change what they do and how they do it. Yeah. Well said.
So that talks about sort of the entrepreneur and the founder, what you look for with them. What about the company itself, or the business idea, or the value proposition?
So one of the things that people get frustrated with us and our peers sometime is the reality of the scale of the opportunities that we need to see. And I had another investor last week who was a angel investor in a company that I had looked at and passed on. And he was like, man, you shouldn't have passed on that a year ago. The company's doing so well. And I said to him, how big do you think it can get? And he said, well, I think this probably, pretty high likelihood it can get to sort of a $250 or $300 million exit. And I said, that's great. If you get there, you will do very well. But I go back to my sort of venture math.
Right, back to your economics.
I've got a $150 million fund. I'm maybe investing, $4 million into this thing. My threshold is like every time I write a check, I need to genuinely believe that I can return half the fund or better in one shot because of that known failure rate. And by the way, after you get to the failure rate, then you get to all the little sort of middling performers where maybe you double your money, or you get 1.5 times your money, or 2.7 times your money. But like doubling $4 million into 8,
right, on
the path to trying to turn 150 into 450, which is what we have to do. It doesn't get you there. So I've got $150 million fund. I'm looking for, $75-80 million of exits at least. And if it's going to be a $250 million outcome, then I need to own 30% of that. And no founder is ever going to sell me 30%.
Right.
So really, we need to be looking for, $2 billion markets and up to justify, nobody ever. How many companies in the world have 25% market share? Right? Like hardly anybody. You need to be able to succeed on single digit market share. And the more capital intensive your business is going to be to build, the bigger the market needs to be. Because if my threshold might be a $2 billion market, somebody you're asking to come and write a $50 million check later, their threshold might be a $10 billion market. So scale just gives you all sorts of degrees of freedom towards how you exit, what the outcomes can look like, and you don't have to make heroic assumptions about market share.
Yeah. So you said that you oftentimes put in multiple rounds of investment into a company. So let's say you did the first round. What things do you look for that will trigger you to make the second investment? Is it top line revenue, profits, market share, geographic expansion? What are the things? What are the trigger points there?
So we will usually make our second investment before top line revenue is, it's still going to be small, but we're going to be excited about a company's progress from whatever their first few dollars to, well, I'll give you a real example. I led a deal it was March or April last year. company that had zero revenue at the time. They did their first, we knew they were about to get their first customer or two, which are, these are like $50,000 contracts. So it was going to be tiny for a while. They kind of clicked midsummer last year and started really ramping. And they went from $200,000 in revenue in July to they're over $2.5 million of run rate revenue now. So that's 9 months. That's pretty 10x, but numbers are too small to focus on multiples. But the point is they've gone from a few customers to 50 customers, and you can see that there's product market fit really emerging here. And I don't know if you've talked about that in your class otherwise, but that's that validation that what that founder created and the market that they thought they were selling to, like we have some really strong, still early, like you can get to $2, $3, $5 million of revenue and discover the hard way that what you've done is sort of skim this thin layer of customers off the top of a market. But this looks like they're onto something. And so we have that confirmation that the original thesis was correct. And we believe that downstream capital providers who will be necessary partners to us are going to read this situation and say, yeah, I want to pile into this thing. That's when we heavy up. That picture looks different for every company, but at the end of the day, it's a little bit of a gut plus analysis read of momentum.
Yeah. So you're investing in startups, and there's sort of startup mode, which is sort of a particular way of running a business and behaving, et cetera. For you to have success, these companies need to break out of startup mode and get into, this is a real business and we have real revenues. We've built out our management team, our leadership team, right? We're hiring employees, we're expanding geographically, whatever. What are the major challenges that you've seen companies have when they're trying to break out of that startup mode?
I think the thing that is the single most common failure point, and one that we try to work really hard to help our companies avoid, is failing to quickly enough and aggressively enough start to build out the leadership team. Moving past that, it's you and me, and we're the founders, and at the beginning we're making all of the decisions and we're doing all the most important work, and getting to the point where you realize you've earned the right to bring in true specialists to take, like, okay, the beginnings of, like, yeah, we got some dogs eating the dog food. Like, now I need somebody to go build a systematic, repeatable process for finding more dogs. And that's a full-time job. And one of the places people fail in that is that when they realize, okay, now I need somebody to, like, find me more dogs on a repeated basis. And the founder doesn't know how to do that his or herself very well. And so they get super excited by the fact that they meet some people who clearly have more experience in it than they do. But they haven't really sort of surveyed the landscape and understood what is great from a talent standpoint, be it in sales leadership, marketing leadership, engineering management, et cetera.
Yeah.
And so one of the things we really try to do is and we have networks of people that we maintain and call on favors from all the time, so that when you realize it's time to hire a real engineering manager to build a team that can really start cranking out product, and that's about people skills and management skills and hiring, and it's not just about who can write the best code. I want to put in front of you a exceptional, like one or two, like truly exceptional. You could never hire them right now, but I want you to sear a vision in your brain of what great is at that role, so that you don't settle. Because people way too often settle for somebody who's good and way better than themselves.
Yeah, sure.
But not great.
Yeah. Excellent way of putting that. Excellent way of putting that. So I think this is my last question or topic: valuation. How do you guys think about valuation? Right, that's always the sometimes a friction point between founders and investors. But what's your philosophy on that?
Well, the definition of the the right price for any company is where supply meets demand. And people are complaining about gas prices being too high right now, but I don't see a lot of people stopping buying gas because it's $4.50 a gallon or whatever it is. So, um, valuation at this stage it's super hard. It's way more art than science. Um, it's driven more than anything by, again, founder quality, experience, talent. And what we try to do is understand, well, number one, for us and our strategy and how we think about building portfolios in a given fund, we need to own 15% of a business to have that venture math work down the road initially, 15 to 20%. And if I can't write more than a $4 million check, that kind of, you can do the math and back
Sure.
into, that implies a clear set of parameters around price. But we also think a lot about, and we can get good data on what are companies like this, what are people paying for companies like this in the next round. And what we want to be able to see is that the price appreciation from our financing to the next financing, we would like to see that at 3x. So if I pay, 20 post for a deal, I want to believe that the next round is going to happen at 60 pre or better. And so we're reading downstream stuff quite a bit. And so what's happening right now, the public markets have corrected. That has led the growth stage guys to start thinking differently about pricing. The seed stage guys haven't quite gotten the memo yet, but it's going to work its way back down because everybody's looking at those later stage things, and it'll take a while, but I guarantee you, within 6 months, seed stage pricing will look pretty darn different than it has.
Yeah. So I think what I heard you say, just to put it a different way, is the economics needs to make sense for the fund, right? So there's a lot of analysis that can go into that. You have a lot of data, and you can analyze that to make sure, okay, yes, this can happen. It has a reasonable probability of happening. And then there's some outside market forces that may or may not make that investment possible.
Yeah, and then what happens is you get with some deals, you get to the point where you're like, oh shoot, we thought we wanted to pay 15 for this, and if we don't pay 19, we lose. Will we pay 19? And then you end up in this conversation inevitably, particularly as a seed investor, where it's like, well, if you found Facebook at the beginning,
right,
it didn't matter what you paid. Right. And that's like, it's dangerous. It's both dangerous to think too much that way and dangerous to not think enough that way.
Yeah.
Because I would hate to lose an iconic company because he got stingy over 15% on the price at the beginning.
Yeah. I once heard somebody say that the question that most people think about is, well, what if this doesn't work? And what you should really be asking yourself is, what if this does work?
What if it does work? What if it does work?
Yeah,
right.
Exactly. Well, Brad, thank you very much for taking the time. Is there anything I should have asked you that I haven't that you'd like to share? Any wisdom there?
I think we talked around it again and again, but I think the thing that people fail to understand more than anything is that the math of this whole business is wildly stacked against you. And so when you win, you have to really, really win. And so like in each of we're investing out of our third fund now. In each of the first two funds, those funds are performing really well because they each have multiple companies in them that will return more, that are at their valuations today are worth materially more than the entire size of the fund itself. And the business just doesn't work unless that happens. And so everything drives off of that. And that's part of what drives to these like incredible evangelistic founders being so important, that what drives, huge markets being necessary for great outcomes. And the other reality is and I spend a lot of my time talking to the investors, the institutional investors who trust us with their money and all of our peers with money. And there's a reality in this business that average venture capital firms produce lousy returns where you would definitely be better off just investing in the S&P 500. And so you have to be good. You have to be really good to survive in this industry. And so everything is about like, that bar has to be so high for all these decisions, and compromising and settling and being like, this is pretty interesting and she's a pretty darn good entrepreneur. None of that will lead to the exceptional outcomes on those like 2 or 3 companies in a 30 or 40 company portfolio in a fund. If you compromise on those decisions, you'll never find the 2 or 3 like crazy outliers that make the whole thing work.
Yeah.
Because most of this business is actually about failure. And it's finding the 5% that carries the whole equation.
Yeah. Great. Well said. Well, Brad, thank you very much for taking the time to be on this podcast.
My pleasure. Thank you.
That was a really interesting interview, Bela. Brad views the VC business as a commodity business, which is kind of interesting to me. I always thought it was, kind of more specialized in this one, where there's lots of differences. But given all the competition that I wasn't really aware of, all the competition for funds and the nature of the industry, how did he create a viable business?
Yeah. And, there's good lessons here for all businesses, not just the venture capital business, because everyone has competition. But investing, whether you're venture capital or angels or mezzanine or private equity, the thing you're giving to your people is cash, and cash is, one of the big commodities that we have, regardless of if it's denominated in dollars or in francs or euros or whatever. It doesn't really matter. But cash is cash. It's all the same. And cash is the primary thing that founders are looking for. But at the same time, as an investor, you want to bring additional value to the founders. And this is a good lesson for entrepreneurs, right? The value you bring to your customers, you want that to be greater than the value your competition brings. And this is what Brad has been focused on and Brad has been doing in the investing arena, which, is sort of a little different take on it. And it's emerging now more and more and more. And you can see more venture capital firms and more private equity firms trying to distinguish themselves or differentiate themselves by the additional value that they bring to their partnership, they're even calling it, with the people they invest in.
Now, this is interesting to me, Bela, because when you and I actually didn't know each other when I first became aware of High Peaks, right? And that's a little preview to our next and third interview that we'll have, but we'll hold off on that story. But I thought it was really cool that you had differentiated in the region that you were in, right? But then Brad and his partner made a bet on differentiating within the highly competitive New York City environment, right? The biggest city in the United States and lots of finance action there. And to me, that seemed like, oh my gosh, that's a big jump. What's your take on this?
Yeah, it is a big jump. So yes, at High Peaks, we differentiated ourselves by saying we're investing in a specific geography of upstate New York, which was sort of an underserved market. And that was sort of what we were bringing to the table. In New York City is a very, very competitive investment market. New York City is by most measures the second largest VC market in the United States. There are over 75 venture capital firms based just in New York City. And they're all competing for the best investments. And the cream rises to the top. And so if you have an experienced entrepreneur You have someone has a really great idea, and you can just tell when you meet someone whether they have the right stuff to be an entrepreneur. So you have these 75 firms competing for the best investments. And, venture capital and private equity has really been a hot industry for the last 10 years. And, in some ways that worked well for Brad and Primary, right? Of being in an industry that's been growing pretty dramatically over the last 10 years. And imagine if you're running a small startup in New York City and you get an influx of $10 million from a venture capitalist. And when you typically, particularly as we were talking earlier, in seed and early stage investing, you don't have a very big company. You may have 2 or 3 or 5 or maybe 10 people in the whole company. And now you get this slug of $10 million. And most entrepreneurs struggle with what to do with that money, right? Because they haven't been in that situation before. And even if they're experienced, man, there's a lot of stuff to do. You need to finish your product development. You need to set up sales. You need to set up distribution, manufacturing, a finance organization. And all of that means you have to hire a lot of people. And finding talent and hiring talent is one of the hardest parts of growing any business, particularly in this tight labor market. So it's a huge, huge undertaking. And so what Brad's strategy has been is not only do they write that check for those millions of dollars, but they also provide you assistance and almost like an outsourced HR function, an outsourced function where you can make connections with other CEOs, an outsourced finance operation, right? To help you sort of accelerate your growth. Because think about it this way. When you hire a finance organization for your business or an HR organization for your business, it really doesn't increase the value of your business. It's part of the infrastructure you have to have. There's no discernible value to that. So Primary's strategy is to sort of think about how can we make it more efficient and effective for entrepreneurs to grow their business. And what we're doing is we're taking the parts that are repeatable in each investment that we make, right? If we make 10 investments, all 10 of those companies need the HR function. They all need to hire people. So we can help all 10 of those if we set up one hiring and talent organization. So that's been their strategy. It's been very successful. And oftentimes that additional value you bring to the investment table helps an entrepreneur decide who he's going to take money from. And that's again, the hottest deals, the entrepreneur is the one who's deciding, right? When we were investing in upstate New York, oftentimes we were the only VC at the table. So the entrepreneur decided, am I going to take money or am I not going to take money? Oftentimes in New York City, in these more competitive environments, the entrepreneur is deciding who they're going to take the money from and who they want to partner with. And so there's a lot of additional value you want to bring to the table, and that's how Primary has differentiated itself.
Yeah, Bela, this really resonated with me anyways, because in my, little more limited entrepreneurial experience than you have, but we had some of the same struggles with getting the right talent outside of our core area that we knew a lot about, but finding the right CFO, finding the right marketing person. And this was great with the story Brad told about, this is the person you want to meet with. Not that you can ever hire this person, but so you know what you're looking for. We had no idea what we were looking for. We'd see these resumes and we were just really guessing. We thought we had criteria, right? But something like that would have been so important. And one of the reasons, and I think, maybe some of the people who are listening to this know the story, that the 2 earlier businesses failed and this third one almost failed, and we brought it back from the brink to be successful, was this idea of finding the right team and finding the right people. The core team was great in all 3 of these examples, I think, but it was these extra really important pieces like CFO and person to run marketing or person to run HR that it sounds like Primary did a great job of differentiating on that factor in a very crowded market. So I think that's really cool, and I think that is really helpful when you're an entrepreneur and you're looking to choose source of capital A from source of capital B. If B can really help us with these key positions, That's a big plus. Or entrepreneurs should realize that you should know what you don't know.
Right,
That's the most
right.
important thing. All right.
Absolutely.
Great, Bella. What do you think? Time to wrap it up?
Yeah, I think it works for me.
All right, so the takeaways today, we kind of defined early and seed stage venture capital. We talked to Brad, and really he explained to us how very competitive this business is, this idea of cash being a commodity business, and one with lots of high risks, not all of them known. The cost to co-founders and founders is really high, so there's a lot of expectations on the role of an outside investor at any stage of the company's early growth. They have to make these big wins, right, in order to get their money to pay off the people who've trusted them with their money, right? So the economics of how this works, Brad made really clear, at least in my mind. And at the end of the day, it's this important of differentiation in building a local network. It's important, and again, this is the repeat of a theme, Bela. It's important for the investor to understand, we have this source of differentiation. Here's what we're good at. Here's what our goals are. And it's really important for the entrepreneur who's getting the funding to understand those goals so that A, they are more likely to make a successful pitch, but B, that it is the right match, that they're making the right choice. Because, as we've talked about before, venture capital is a dicey situation for the entrepreneur. It means they're going to be forced into an exit in most cases, right? Whether they like it or not. They need to understand that and make sure that these goals, in terms of time frame, in terms of expectations, are similar, so that it's a good relationship, like any relationship between organizations. So that's kind of in the nutshell, I think, what the wrap up is of the interview with Brad. It was fantastic. Thanks for doing it, Bela.
Yeah, great summary, Mike.
Listeners, thanks for joining us today. We hope you found this episode interesting and thought-provoking. If you have any questions about what we've discussed, please, as always, feel free to get in touch with us. Our email is bela.and.mike @gmail.com.
Hey, and please do follow the podcast if you haven't already. So until next time, signing off from upstate New York. See you soon, Mike.
Sounds great, Bela, from over here in Münster, Germany. See you next time.